So central banks, obviously the guardians of macroeconomic and financial stability, you've been focusing on the risks from climate change for some time and trying to use the tools that you've got available. It'd be great if you could just sort of set the scene for us in terms of how far you are on that journey and what still needs to be done. Thanks.
So it was 3 years ago that we first set supervisory expectations for the banks and insurers that we regulate to manage the financial risks from climate change. And at the time that we brought those expectations in, many institutions still had climate change in the corporate and social responsibility box. Only a handful had the strategic approach that was necessary to think about the tragedy of the horizons and how actions today can reduce their future risks and create future opportunities. There's been a sea change, frankly, over that 3-year period, prompted in part by regulatory intervention, but more broadly, investors and stakeholders widely have moved on the debate. So it's no longer a question of whether climate change is a financial risk and creates financial opportunities. It's a question of how do we best realize those opportunities? How do we best manage those risks? What does that mean in practice? It means firms like Bruce's are investing in developing their risk management capabilities, methodologies, and data. They're having regular conversations around the board table on this topic. Huge improvements already in disclosure. Some of the UK financial institutions are leading the way on that. And we're seeing ambition, Alice, as evidenced in GFANZ. All of that is fabulous, but there is so much more to do. The International Sustainability Standards Board is leading the charge on embedding disclosure in the real economy. That's absolutely essential if the financial system is going to do its job. We need to embed these issues in business as usual risk management and climate engagement, not just doing one-off exercises once a year prompted by regulators. And importantly, we need to make sure we're driving the right behaviors, greening our future economy, not investing in the currently green. To support that at the Bank of England, we're looking at the system-wide impact of all of this. Our climate scenario analysis exercise, the results will be published in a couple of weeks. We're ensuring through our active supervision that firms are meeting these expectations. And we're also enabling firms to do it by sharing best practice as well. None of us know how to manage these risks and grasp these opportunities, so sharing our experience is good. And the final thing, perhaps, to mention is we're taking all of this internationally. The Central Banks and Supervisors Network for Greening the Financial System has gone from 8 to, I think we're at 115 in just a few short years. So great progress, but a lot more to do.
Thanks very much, Sarah. We'll come back to some of those issues shortly. Bruce, you're here representing the financial system. When you think about what public policy makers could do that would make the biggest difference to the financial system in terms of creating incentives to transition, what's on your mind? What would you like to see?
Thank you. I think there are probably three things principally on my mind around this. The first is around measuring and tracking our progress. And I think this is a key issue that a number of people have focused on in a number of places. The Sustainable Markets Initiative is looking at this. The ISSB is looking at this. And we need to bring this together really as quickly as we can, because there's a danger of fragmentation of different measurement systems, which I think create confusion. They create the potential for greenwashing. And what we've got to avoid doing is doing something smart for ourselves that effectively only just pushes the carbon issue somewhere else. And so I think we've got to get launched a a measurement system, even if it's in modern parlance a minimum viable product to start with, around which we can then build more complexity and nuance as we go. But without that, I think we're struggling to convince people we're taking enough action. I think the second issue is the sort of public-private partnership that's necessary here. The largest class of insurance business that we insure at Lloyd's are natural catastrophes around the world, so hurricanes, floods, drought, and these things are typically limited by time and place. A hurricane happens in a certain place for a certain time, and so they are capable of being risk managed. When you get into the area of systemic risk, it's much, much harder to get your arms around this, and these risks are typically too big, not just for insurance companies, but for banks and indeed other sectors of the economy. We just are going through a pandemic where exactly that issue has come to light. A pandemic is everywhere at the same time, and it is not yet limited by time, and certainly not limited by place. And so we've seen how governments have had to lean in to their economies aggressively to provide support for citizens going through this process. Climate change will be multiples of the issues that we faced in the pandemic over time. And my view is that actually the risks end up with government. Governments around the world have ended up nationalizing risks of this kind, and there's a moral hazard now that has grown up in terms of what the citizen expects of their government in terms of support. And so I believe it's absolutely in government's interest to engage with the private sector to try to generate capital support for these plans. We've seen quite good partnerships historically on issues of terrorism or of flooding that give us some quite good templates for how this might work. And certainly at Lloyd's, we set up something called FutureSet, which is essentially our brains trust for research into this space. And we make the technology and the research available in an open source way to all comers to try to encourage these debates and these partnerships across border and across a sector. And indeed, I think it's one of the benefits of the Prince of Wales' Sustainable Markets Initiative that you interact with people in different sectors and begin to understand their challenges and begin to try to create shared responses to that. And then the third one is what we call in the insurance world ensuring the transition, but it applies to businesses in banking and indeed across the real economy. We cannot do other than support our customers going through transition, provided they're transitioning. And I think sometimes the debate is presented in too stark a sense of black and white. Fossil fuels bad, renewables good. The world has a need for fossil fuels until we are able to replace the energy supply chain entirely with renewable and sustainable energy. And in many cases, I think some of the most intensive carbon generators are also the ones that are investing most in changing their business models. And we should be encouraging that, provided indeed they're making progress in that transition. And so support for these industries rather than kind of cancelling them is incredibly important for insurers, financiers, professional service providers along that journey. And again, it would be helpful if there was more recognition of this to provide support in this transition rather than the slightly black and white approach to essentially cancelling anybody who is in the business of fossil fuels, for instance.
Great, and yeah, let's come back to some of those rich topics. Bryony, so you're advising clients, including in some of the sectors that we perhaps haven't discussed so much over the last 24 hours. What are your clients saying to you about what they'd like to see from public policy?
Yeah, thanks, Alice. So I also, in addition to working with banks, work with investment funds and fintechs as well. So, bringing that kind of broader, perhaps financial industry perspective. I think it's very clear that those participants and everybody here in the room, really willing agents for change in this respect, and clearly have, faced up to this challenge and really taken on the challenge alongside the opportunities. But there's a lot of difficulty around implementation, and we've heard a number of kind of repeat themes yesterday, and Bruce, you've just picked up on some of them again just now. And I think I just want to highlight and maybe emphasize three key themes in those challenges across all those industries. The first one is uncertainty and the portfolio effect, and I'll come back to what that is. Investability for credible brown transition, and that's exactly really what you just touched on, Bruce, from the insurance context. And also broader ESG risk concern and risk mitigation. So on the first one around uncertainty and the portfolio effect, all these net zero challenges, planning challenges in the real economy, they're just compounded for banks, for lenders, for financiers who have to assess and report on a portfolio basis. And I think yesterday, one of the LSEG panelists said that something like 50% of the kind of estimated carbon sort of outcomes from their investors were wildly inaccurate. And I mean, that's just, that just shows the compounded effect that uncertainty in that real economy space has when you aggregate that across a portfolio and have to report then on that basis. So the Transition Planning Task Force is clearly a welcome announcement, but I think the real concern is timing, right? Regulated institutions are in their first mandated reporting period. We really need substantive outcomes within 12 months. Also, there is a need to narrow down the focus. There's been a proliferation of service providers and frameworks and structures, and that was also mentioned, of standards. And that's really unhelpful, I think, when you look at especially smaller businesses. They don't have the tools, the resources, or frankly the time to assess the quality or the relevance or to compare amongst all of that. So if policy, and if one of the outcomes of that task force can be to try to narrow down the focus and give some centralized direction, I think that will be really valuable. Touching quickly on investability of credible brown transition, it's often said that, in terms of intensity of impact, so where can you put your money to make the most change, it's exactly in this area. And I think there's a lot of, as Bruce said, desire to really commit, to really plan, to really make changes for those industries. And financiers and insurers need to be enabled to support that. And at the moment, I think there's a lack of a robust, trustworthy, brown to green transition framework. And that's causing barriers, and it's difficult to act. And Commissioner McGuinness, unfortunately, isn't here, but I had read one of her speeches from last year talking about, the need to focus not just on the end game and on green and on 2050, but on the intermediate steps. And that's really what this is. We're thinking, how can we put a brown to green transition framework in that does those intermediate steps to get us to that desired end game? And the final point, very quickly, broader ESG risk mitigation. Okay, so greenwashing is often mentioned, but beyond greenwashing, we understand that fast-paced change is more likely to give rise to unexpected outcomes. And everybody talks about net zero as a race, and we're all focused on quite narrow, net zero and climate focus in this. The risk, therefore, of unexpected negative externalities arising is, I think, reasonably high. And I think that's recognized, certainly amongst my clients. They come to ask about things like, how does biodiversity and nature risk or broader environmental risk, what about water quality and availability? How does that fit in? There's a lot of learning, mapping, and analysis, I think, that needs to be done on mitigating broader ESG risk so that focus and speed and scale can be committed to the climate transition in a sort of more risk-comfortable way. We need a bit more confidence around that in order to reduce those barriers to action.
Thank you. That's a very rich set of interventions to get us going. What I wanted to pick up on next, actually, was to come back. I think all of you mentioned the challenge of transition and took different angles on that. And Sarah, if I could come back to you first. So obviously the bank thinks about transition from a macro perspective as well as a financial stability perspective. And I know you've been thinking a little bit about how we can transition in a way that's coherent and sensible. So if you could say a few words about how you're seeing it, that would be great.
Yeah, and it very much picks up on the themes that Bruce and Bryony have mentioned. Look, transition is going to require the combined efforts of many different participants. It's government, it's business, it's the financial system, it's financial regulators and central banks and individuals. That's all happening in an environment where there's a huge amount of uncertainty and where we've never done this before. So the potential for unintended consequences here is very high indeed. The path to net zero matters just as much as the end game, and the possibility of bumps along the road as we get there feels quite real. Now, the role of the financial system in that context is to allocate capital, to invest so that the currently dirty are able to get to net zero. The alternative of paper decarbonisation does not reduce emissions, and worse, it risks making us think that we are making progress when we are not. So to avoid that unintended consequence of pushing emissions into the shadows, and to ensure that we are doing the job of supporting those that are credibly moving towards net zero, we need transition plans. That will enable the financial system to distinguish between those that have a plan and those that need one. And without those, the financial system, I don't think, has a hope of steering the economy in the right direction. And so the work that GFANZ is doing, the work that the Treasury is doing, is incredibly important. The second area where I worry about unintended consequences is when we think about this at the level of the system as a whole. Are we collectively delivering a transition that is consistent with the needs of the economy and the needs of society on the way there? We've all been reminded rather rudely recently of what happens when there are imbalances in the supply and demand of energy. And so the possibility of unintended consequences from individual actions here is very high. So what we're doing as the central bank is looking to ensure that we provide economy-wide scenarios so that individual financial firms know what the economy needs in terms of energy, and a pathway for climate regulation and carbon prices as much as that's known. And the second thing that we're doing is understanding what the sum of individual lending decisions is, what that means for the economy as a whole, given it's in our collective interest to finance the transition and to manage those bumps in the road. I did want to emphasize that we're doing this in an environment of uncertainty. There isn't complete clarity about what climate policy is going to be. And it's unrealistic to expect us to be able to have that. But in the picking up Bruce's theme of minimum viable product, we need to start having a go. So recognizing that there is uncertainty, using scenario analysis to look forward under different future states of the world, having transition plans so that we can understand the different plans that individual firms have, and adding it all up and remembering that it's the system as a whole that matters. I think together those things can help us do the best possible job of managing the uncertainty and managing the bumps in the road.
Thanks very much. I mean, just to pick up on that, I think perhaps what we've managed to do with the NGFS scenarios is perhaps one of the slightly underappreciated bits of global public infrastructure that's emerged. And we now have it seemed like it wouldn't happen a few years ago, but we now have these common scenarios that are open source, people are using them. Of course, they need further investment. We know there are areas that we need to further work on. But having that kind of common tool that we can all use and communicate, regulator to private firm,
That's right.
cross-border, et cetera, seems quite important. Yeah, that's very helpful. Thank you. And Bryony, just to come back to you, I know you've been thinking, what we've described here is quite an ambitious set of things we're trying to get done, but I know you've been thinking a little bit about whether we should be ambitious even more and making some links between technology and the challenges we're trying to address and so on and so forth.
Yeah, so the fintech piece, but just before I go to that, just picking up on what Bruce just said, I think there is this issue with top-down policy consistency. I think that's sort of what you're highlighting on an international level. But consistency can also be driven in a sort of bottom-up way. And just to make a statement about professional services firms, the way that we're a global law firm. We've got offices over 50 offices around the world. We obviously are also cross-sector, so that whole thing about trying to connect up with thought leadership amongst sectors and also bottom-up consistency. Professional services firms really do have an important role to play there, especially where the top-down consistency is not in evidence. So there's the first point. Moving on to the digital finance and maybe the technology sort of contribution potential here more broadly. So we do work with some of the networks that represent the digital finance industry, and there is a sense of unexploited potential with regard to that industry's ability to help with implementation of transition and net zero. And I think if you look at the stated policy goals for the City of London, obviously we've heard already a lot about the intention for London to be the world's first net zero financial centre. It is also a stated policy goal for London to be the world's preeminent global fintech hub. And so in the crossover of those policies here in this ESG space, I think there's enormous underexplored potential. I know not everybody in this room necessarily shares a positive view on the digital assets and fintech industry, and I think we should explore why that is. As an industry, it does have its own ESG challenges, as many others do. I don't want to encourage the direct connection between Bitcoin and energy use and the digital assets industry more broadly, because it is a much more nuanced and broader conversation than that. But there is an energy usage question and an energy efficiency question, and the industry is working on how to solve that. It also has issues at the moment around credible transition planning, and in fact is one of the sectors, it was mentioned yesterday, there are sectors that don't have science-based pathways. It doesn't have any science-based pathways. Those have not been developed, and so we're helping to work with the industry to do that, to work in working groups, to build their own best practice and their own science-based pathways, because it's not in existence at the moment. So those are some of the challenges, but where are the opportunities? That's what's often said, but really, what is the relevance here? So just to highlight a few of the things. I think one of the more obvious points is on supporting this data and disclosure and reporting challenge. Okay, so the FCA's recent ESG sandbox had a number of very promising businesses offering these data and disclosure in the ESG context solutions. And that's one area. Another area is perhaps enabling the demand side. So coming out of a conversation I had yesterday, there's a lot of a question at the moment around behaviour, around consumer behaviour, around how do we enable the demand side here. And I realised that fintech really does have potential to give consumers more direct ownership over their spending and consumption choices. In doing that, to understand their carbon profile and to begin to adapt how they behave, what they do in order to create more net zero aligned carbon profile. To understand and own their own supply chain. You know, when you start to really, it's not visible, is it, at the moment? You know, as a consumer, it's rarely visible. So being able to provide that transparency, that's also a great potential. And then perhaps also, you know, some ownership of energy usage. Sourcing your energy, deciding where it comes from, and owning energy usage. I think that's another great area of potential. So that's enabling the demand side. Then on carbon credits, I think it's been well explored. You know, there's a lot of potential for blockchain digital assets to support on the voluntary carbon markets. And finally, in the investment context, and this might be a little bit more niche, but one thing I think that certainly tokens can do is connect outcomes to inputs really closely in a very transparent, immediate, disintermediated way. And if you look at investing for purpose, to my mind, there's a real attraction around that. You know, if you can, as a stakeholder, you put money in, and then the kind of purpose-driven outcomes of that are more immediately connected to the investment that you've made, I think there's potential there too. So, yeah.
Thanks very much. Lots of food for thought there. Just to pick up on one of the things that's come up, you mentioned it just now, it came up slightly earlier. When we were thinking this time last year about, you know, as the financial sector, what we most wanted to see, one of the themes was around carbon pricing, and of course there's kind of public solutions, and then there are private market solutions as well, and perhaps we need both. I was just interested in views across the panel on, maybe starting with you, Sarah, like how would it make a difference to what you're doing if you had a bit more certainty on future carbon prices, for example?
So carbon prices are the signals that tell us the pathway that will get us to net zero. So just as Bruce said, if there were greater certainty about that, it would make all of our jobs easier because we would know more precisely how we were getting to net zero, not just that that was our destination. Realistically, that we're not going to get hugely precise pathways, but that doesn't mean we can't do anything about it. And that's where I think scenario analysis, building carbon prices into how we make decisions now, recognizing the uncertainty around them, is something that we can do. To be clear, climate policy, carbon pricing, all of environmental regulation, that's for governments, not for central banks and the financial system. But what we can do is build in expectations of what that might be into our decisions to try and drive the right behaviours. And I quite often make the analogy with interest rates. None of us knows what bank rate is going to be in 12 months' time, but that doesn't mean we ignore it in every financial decision we take. And I think we need to get to the point where thinking about carbon and its future price, where that creates risks, where that creates opportunities, is embedded. That goes to Bruce's point, to regulators, as we think about the capital framework. Where do we see that risk, that opportunity in that? It goes in every single lending, investment, insurance decision that's made today. And again, just to plug our scenarios, there's some pathways in there that are consistent with orderly and less orderly scenarios that people can use to give a sense of what the future might look like. Don't ignore it, even though you don't know what it is.
That's very helpful. And then on the insurance side, I mean, you don't necessarily have to focus on carbon pricing, but do you feel in what we've discussed so far, we've sort of zeroed in on the things that would make the most difference to the insurance sector, or are there additional things on your mind?
Well, I think there are a huge number of things that we can do. Ultimately, where I think the insurance sector will get to is a kind of risk appetite for carbon that will tighten increasingly as we get on this glide path to net zero. And so we need to start, as we talked about before, with the right measurement system, and then we need to be taking the right actions. Now, of course, what will happen is as you can constrain the supply of capacity, your risk appetite goes down, prices will almost certainly go up. But this will also be helpful in making the transition to new technologies and new industry more attractive for investment. And so in terms of the absolute level of the economics on this, I don't think there's overly a challenge. There's huge short-term headwinds which we're all facing at the moment in terms of energy security and energy pricing, affordability, as we try to go on this journey. And part of the issue is engaging with consumers and users of energy more broadly, so that they're persuaded we're all doing the right things. And I suspect that if the government was willing to offer somebody £50 a month off their electricity bill, they would take that more quickly than take a £250 or a £500 subsidy for a heat pump. And so there's always a risk that the immediate crowds out the long term, and this is particularly a challenge in climate change. So we saw how the world came together really quickly around Ukraine, but it was very immediate and very much in front of us. The climate issue for too many people is just over the horizon, so it doesn't matter very much if I wait a minute or wait a month or wait a year. But of course it does, because we absolutely know that if we don't embark on this transition, and we talk about it being urgent but orderly is really what we've got to do in order to avoid the unintended consequences we spoke about before. But the more we do up front, the less we'll have to do at the back end. And if we're going to avoid cliff edges in these transitions, which will create as much risk as it potentially mitigates, we need to get started early. And I think we've also got to be a little bit careful with carbon offsets. At the end of the day, they are just offsetting rather than reducing carbon. And the idea that as long as I own enough trees, I can be a carbon generator doesn't work, because we know in aggregate across the world there aren't enough trees, which is why we've got global warming going on. And so for some people to capture the trees at the expense of others isn't going to provide a global solution to the problem. So we've got to be doing things not just in terms of the supply, but also in terms of the demand for our most carbon-intensive industries. And it isn't just fossil fuels. We talked about transportation. We talk about the construction industry. And we need solutions in all of these things. And it comes back a little bit to we're looking at an elephant, but we've got to sort of eat it a slice at a time. But we have to have enough people with their carving knives out, taking slices off, that we make the problem smaller as quickly as possible.
And one thing I'd like to just return to in the last 5 minutes we've got is sort of the role of the city here. So we've heard lots in the last 24 hours about the UK showing leadership in terms of transition planning, in terms of becoming a net zero financial centre. But what sort of priority do you attach to finding ways to work globally, and how are you going about that, trying to achieve global consistency? Because I know that you all have a different interest in avoiding fragmentation and trying to build common solutions. I don't know, Bryony, you mentioned your clients being very global and
yeah, I mean, not just clients but colleagues as well. I think that's one of the strengths of global law firms and other professional services firms, is the ability to take on board expertise, learning, etc., from the multiple jurisdictions in which we operate, and then begin to assimilate that into kind of best practices, which then, whether or not other jurisdictions are from that top-down policy level at that stage, can still be shared, because when it's inherently valuable, it's inherently valuable. So you can then share those approaches in terms of documentation, frameworks, strategy advice, stakeholder engagement assistance, for example. Those types of structures that sit around the edge of how to make this transition happen are really, really important. And I think that the ability of firms like ours to get the best practice from multiple sources, assimilate it, and then begin to disseminate it around the world. I mean, we've got big networks, for example, in Africa, in Central and South America. You can really get that frontline piece as well into the conversation in a way that some of the financial institutions here will have obviously emerging markets practices, but I do think that frontline experience is really available through the professional services network, and that's a good thing to plug in as we all think about it. We haven't really mentioned just transition, but in that respect as well, really important that we have that voice at the table.
Yeah, and Sarah, what sorts of things is the bank doing about trying to forge global consistency? And
it's a global problem, global solutions. None of us know how to do it. So the gains to trade are very high as we share expertise. So the international angle of this has been hugely important to the bank throughout. I mentioned before the Central Bank and Supervisors Network for the Greening of the Financial System. We were a founder member back in 2018, one of 8. There's now more than 100. And what the NGFS has done is fast-forwarded the thinking so that we've got the equivalent standards, frameworks, ways of thinking about things that can be seeded into the international system, the international standards boards. And so we've been able to make much more progress as a result. We're having discussions in the IAIS, we're having discussions in the BCBS, we're having discussions in the FSB, and yet more alphabet soup of international standard setting bodies. But that's good because it means we're getting up the learning curve as quickly as we possibly can, both because we need to and because that way everybody can learn as quickly as possible. And it does enable somewhat different voices to be heard. Your point about the emerging market economies and a just transition, hearing those voices is incredibly important in making sure that we take everybody with us on this journey.
Yeah, it's been very powerful. Bruce, any final words on, you mentioned before, that you're at the heart of a global market, you've got firms, capital coming from all over. How much difference would it make for you if we can find common frameworks?
Well, it makes a huge difference. So I think when I think about it narrowly for insurance, or even more narrowly for Lloyd's, it's really in 4 dimensions. It's about partnering with other traditional insurance companies around the world to bring that scale together. Secondly, it's about partnering with new technologies, so insurtechs, and we host insurtechs in the Lloyd's lab to try to bring new technologies together with the traditional market. The third issue is partnering with our customers to understand their challenges and how we can support them. And then the fourth issue, which we talked about right at the beginning, is how we engage with governments to try to get governments to create that level playing field and consistency of data and shared standards.